Thank you for joining us on Savvy Senior Sources, Talking with Experts. Let's take a moment and hear from our sponsors, GWG Life and Reverse Mortgages SIDAC.
Provide for your long-term care. Convert your life insurance towards payments for long-term care. If you are concerned about future health care, you can convert your life insurance to pay for home care or assisted living. Health problems can be stressful enough without the added burden of financial obligations. If you feel that you no longer need your life insurance policy, you may want to apply the value towards long-term care.
Hi, I'm Beth Paterson, a certified reverse mortgage professional with Reverse Mortgages SIDAC. Mike and Carol decided that they needed a one-level home to fit their changing health needs. They used the reverse mortgage to purchase their new home instead of using conventional financing. This has benefited them greatly. Barbara decided to do a reverse mortgage to pay off her conventional loan that she was making monthly payments on. She had funds left in the line of credit after paying that off. And a year or so later, when she fell and broke her shoulder, she was able to tap those lines of credit to pay for her home care. As she said, she would have been up the creek without a paddle without the reverse mortgage. If you'd like information on how to receive security, independence, dignity, and control in your retirement years, contact us. Hi, welcome to today's episode of Savvy Senior Sources Talking with Experts. Savvy Senior Sources guide your way through resources A to V for seniors, boomers, caregivers, and their advisors. In addition to the show, we also publish a Savvy Senior Sources guide, and we encourage you to visit our website, savvyseniorsources.com, to get more information on resources as well as how to access the guide. And I'd like to take a moment and say thank you to our sponsors who make the show possible, GWG Life and Reverse Mortgages SIDAC. Now I'd like to welcome my co-host back for another show, Deb Nygaard from Arthur's Residential Care. Thanks for being with us again.
Thank you so much for having me.
Sure, it's a pleasure. And today's topic is reverse mortgages. And I've invited Professor David Johnson to be our guest on the show today. And he is an associate professor of finance. Welcome. Glad you could join us.
Thanks for inviting me. We're talking about my favorite topic today.
And obviously one of mine also. And we are going to be doing two shows because of, as we were talking, we've got a lot to cover. So let's start out a little bit and tell us a little bit about, you wrote a paper on reverse mortgages and
That's
the
correct.
background on that.
Well, let me give you a little bit of background on myself real quickly.
Yes.
I have a PhD in finance from the University of Tennessee. I've taught at a number of different universities. I'm in transition right now. I'm going to be going to Maryville University in St. Louis. I got interested in the reverse mortgage industry because my parents were looking for a solution, and that's kind of how I came upon it. The research, well, actually I worked in the reverse mortgage industry for a number of years. And it became very frustrating with all the misinformation out there. Mm-hmm. So when I came back into academics, my research, the focus was on trying to clear up some of those misconceptions. So originally that's what the paper that I published, what the idea was about, but it kind of morphed into a few other things. I realized the importance of people understanding how a reverse mortgage works and how important it can be as part of a financial plan. So I learned a lot actually writing the paper.
Good. And I do blogging for the same reason, because there's so many misconceptions about reverse mortgages and I want to get the facts out. And as we know, you can't cover anything in a brief commercial. No product is covered in a commercial. And we're encouraging people to explore and get facts and learn that.
You know, I think it would help me just to understand a definition. What is a reverse mortgage?
Well, a reverse mortgage is where an individual, or actually it could be a couple, 62 or older, has the opportunity to access some of the equity out of their home. So it's a loan, but the key elements of this loan is you don't have to make any monthly payments as long as you remain in the house. So if you live there till you're 120 years old, during that period of time, you never have to make a single monthly payment. It's a non-recourse loan, which means if the loan exceeds the value of the home, when the loan comes due, which is when you permanently move out of the house, nobody has to make up that difference. So, for example, if somebody owed $200,000 on the reverse mortgage and the home was only worth $150,000, their heirs or them, if they choose to move out before they pass, are only responsible for whatever the home is worth. So it's,
The due date on the mortgage is actually the borrower's 150th birthday.
Oh,
So, in case somebody's living to, you mentioned 120, but yeah, as long as they're living in the home, they could be 150. And I tell my clients that if you're going to reach 150, you'll have so much news coverage of reaching that age that you'll have plenty of money to pay the reimbursement.
that's a goal to shoot for.
I have a client who's told me that. And they don't have to make monthly mortgage payments. However, we want to clarify that they are still responsible for paying property taxes and insurance. And
Yeah, sometimes the easiest way to think of it is it's very similar to a forward mortgage. You have the same rights and responsibilities that you do with that, except you don't have to make a monthly payment. So you still retain title to the house. You could still leave your house to your heirs. You could do anything with your house that you can do with a forward mortgage. The key difference is you don't have to make a monthly payment, and you're able to access some of the equity out of your home without having to qualify based on income, credit, those sorts of things.
although we now are doing a financial
That's
assessment, so it is a little different, and we are looking at income and credit from the standpoint, we're still not using a credit score, but we're looking at credit and debt payment to make sure borrowers are able to pay property taxes and insurance going into the future.
so are those the primary qualifications then, or what else
Yep.
would you look for?
Primary qualification is you have to be 62.
Okay,
You have to own your home. You could still have a mortgage, but you have to own a home because,
okay,
I've had people ask me if they could do it on their apartment.
I see, sure,
And it has to be your primary residence.
okay.
So very easy to qualify for as long as you're old enough and you have enough equity in your home, you generally qualify.
Yeah.
And would both, if it's a couple, they both have to be 62?
It used to be that way, but they've changed that. Now just one of them has to be 62, but the amount of the benefit or the amount of the loan that you receive is based on the age of the youngest person. It's based on the interest rates, and it's based on the value of your home up to a limit. So.
Well, that was going to be my next question, was
Wow,
how
see,
much,
I'm
how
ahead
much
of you.
can I borrow?
Well, again, it's a function of the age of the youngest borrower. The older you are, the more money you get. So this is one time where it's an advantage to be older. And ladies sometimes lie about their age, but not in this case. So the older you are, the more you get. The lower interest rates are, the bigger the benefit, and the more valuable your home up to the lending limit, which I think is
625, 500
Yeah.
right now.
Exactly. So, and then there's a formula that determines a percentage of the equity that you could borrow based on those three things. So it's a little bit of a moving target because the only thing we know for certain is that you're going to get older, until you pass at least.
Sure.
We used to be able to say that home values are always going to go up, but that's not true anymore. We found that out the hard way. And interest rates is really unknown. I mean, right now they're very low, and in the future I'm sure they're going to go up. But so it's those three factors that determine it. So, one of your blogs I was reading talks about the timing of a reverse mortgage, and I found it very interesting what you said because people sometimes try to decide when is the best time to do it. And a lot of times they think, well, if I wait another year, I'll be older, my benefit will be larger. But if interest rates go up, you can wash away all that. If your home value goes down. So, I generally tell people who ask me, when's the best time? When you're comfortable to do it.
Yeah.
When it
and
makes sense for you.
Yeah, and that's a good response. But people need to, one, understand it, and because there are so many misunderstandings about it. And a lot of times they call us, and it can be 6 months, a year, sometimes 5 years before they decide it's right. but get and understand it and get the facts about it is what we're trying to do. And yeah, the blog you're referencing, we talk about the advantage of doing it now, and that leads into one of the other things. The funds from the reverse mortgage are received in, you want to talk about that and then we'll come back
Yeah,
to
there's a number of different ways you could receive the funds. You can take it as a monthly payment, and there's two options there. A 10-year monthly payment goes on for as long as somebody on title remains in the home.
I always clarify TENURE, not 10 years.
Yeah, 10 years.
Thank you.
Exactly. You could take it as a lump sum, subject to some limits. Yeah, I think it's less than 60% the first year, otherwise the mortgage insurance premium is higher. Or you can take it as a line of credit. The line of credit has this unique feature. It has a growth rate, which we don't call it an interest rate, but it's comparable in that if you have a line of credit of, say, $100,000, do you know what the growth rate is right now?
The growth rate is dependent on the current interest rate plus 1.25%. So if the interest is 3%, and I'm just using a round number, 3%, then the growth rate is 4.25%. And it will change along with the interest rate. So if interest goes up to 5%, the growth rate is going to be 6.25%.
That's the great thing about the growth rate. It is always higher than the interest rate on the loan that's accruing. So if you had a $100,000 line of credit and you didn't access any of that money, next year, in this case, at 4.25% or 4.25 growth rate percent, you'd have 104,000 plus. So it's almost like an investment in a certain way, in that line of credit is always going to get bigger and bigger as long as you don't access it. And that's a huge benefit, I think. If you went out and you got a home equity line of credit, it's not going to do that. The other issue with a straight home equity line of credit is at some point they could cut off your line of credit. I had a home equity line of credit for my home in Las Vegas, and when things got tough, they just shut it down. With this,
or when the banks closed, they
well,
were shutting them down.
But with this line of credit, it's there, and as long as you have funds available in that line of credit, you can access it. So there's so many different ways you can use that line of credit. It's almost, kind of like a nest egg that's going to grow. So even if you may not need the funds right now from a reverse mortgage, if you go ahead and do the reverse mortgage, you have that line of credit set up, nobody can take it away from you. You can access it whenever you want. If it's an emergency, for long-term care issues, anything. That's what's really neat about that line of credit.
And the blog article that I wrote is think you don't need a reverse mortgage, think again, you may want one. And in there I reference that if you have a $200,000 home and you're 63, you take the reverse mortgage out now and then leave the funds in the line of credit. When you're 73, you have $130,000 available. And when you're age 83, you have over $300,000 available. And that's often when you're needing the long-term care and how it can be an advantage. And even if you take out $5,000 a year, you still are having more in the future available to you. And as you touched on, when you're older, you get more money. But if the interest rate is higher, and which we predict, and I think in my example, I do a comparison of a higher interest rate, and in 10 years, they will have more money in the line of credit than they would if they wait to do the reverse mortgage.
Wow.
That was a great example, by the way. I looked at
Thank
that
you.
and I thought, actually, I think I'm going to take that and take a little bit further and do some research and try and publish
thank
it.
you.
Yeah, no, I mean, that was a great example, and people don't think about that. They, there's, like I said, there's so much misinformation about reverse mortgages. People don't realize how creative you can be, how many different ways you could use it, and how it makes sense to set it up now, even though you may not think you need it now because you could use it in the future. But part of the research I did focused on the aging population. We're all living longer, and we all underestimate how long we're going to live. And that's putting pressure on Social Security. And if you go back to the 60s, there were about 5 people paying into Social Security for every one that was collecting. Now it's about 3 paying in for every one that's collecting. In about 15 years, there'll be 2 paying in for every one collecting. And the biggest group paying into Social Security right now are baby boomers. They're all going to be on the other side pretty quick. So we need to start thinking about and planning what we're going to do in the future, because most of us are going to outlive our assets, and if we don't have some alternative or think about it now, it's going to be much, much tougher when it occurs.
Yeah,
Yeah,
definitely.
And other issues like, your health changes. If it's a married couple, you're relying on 2 sources of retirement income. If one passes, generally the expenses don't get cut in half, but the income might get cut in half.
Yeah,
Yeah, so these are things that people need to think about, and that's why I'm so passionate about people learning about reverse mortgages and trying to put it in as part of their retirement plan, whether they're currently retired or they're going to do it in the future.
talk a little bit more about some examples and using especially the line of credit for the planning into the retirement. I gave the one that I did in my blog, but I know your paper has several examples also.
Well, when I was in the business, I used to tell people that, because they would ask me, what can I use the funds for? I said, whatever your imagination can come up with. And some of the most creative people I've ever seen when it came to using the line of credit were seniors. And this was even before I even thought about using it different ways. Initially, I just thought of it as, well, it's a nest egg. It's sitting there. You can access it when you need it. And that's a fantastic thing to have.
Yeah.
But when I lived in Las Vegas, my wife and I were both originating reverse mortgages. She did clients who kind of were at both extremes. Some of them, you'd look at it more as a loan to last resort, but she had other clients that lived on the TPC golf course, which is like the most exclusive area in Las Vegas, and they would take the reverse mortgage funds, that line of credit, use it as a revolving line of credit. They'd be able to access money, pull it out, use it for some investment purpose. Now, I'm not advocating people do that, but
No.
just one example.
And we just want to say too that they need to be separate. You can't have cross-selling of the,
Oh, absolutely. Yep. Yep.
There's rules against that, so we just want to.
No, I agree 100%. Well, the other thing I did when I originated was I told, because sometimes I get referral from maybe a financial planner or somebody else, and I would always tell my clients, these funds are for you to use any way you choose. You do not have to buy any investment product. You don't have to buy an annuity. You don't have to, you do whatever you want with it. It's your money. But anyway, this one person that took out this line of credit, he would use it as a revolving line of credit. So he'd use it for some purpose, then he'd pay it off. And he thought it was the greatest thing in the world because he didn't have to pay it off, but he could pay it off, and that line of credit would never get shut off. He's still doing the same thing today. Other people use it for purposes like setting up long-term care. And long-term care is going to become a very big issue in the future, and I think a lot of us, especially some of the younger baby boomers, we haven't planned for that at all.
No, unfortunately
And
not.
the cost of long-term care, well, just health care in general, is not cheap. There was a study done in 2012 where the average couple that's 65 years is going to spend roughly $300,000 out of pocket for health care and long-term care. Now, I don't know.
Eye-opener.
Well, not very many of us have planned for that. And even if we planned and we did our best to invest, save, everything else, events occur like this last recession, kind of wiped out a lot of that wealth. Most people, their largest asset is their home. And historically, there was no way to figure out how to use the funds out of that home. The reverse mortgage is kind of the perfect solution, where you don't have to sell, you don't have to refinance, you don't have to take out a home equity line of credit that requires payments. It's kind of like you have this big piggy bank, you've been putting money into it all your life, and you couldn't figure out how to open it up, but now you can crack that thing open and use some of the funds that are yours. So.
Yeah, and you work with residential care homes, which are like homes in the explain
Just
them.
right in a neighborhood, and so instead of the large apartment-style complexes, we have a home. It's 6 bedrooms, and we just have 6 clients. And for some people who have a high level of care, a high acuity of care, they do better in a smaller setting.
Yeah.
And so, and usually it's the person who needs the care, or always the person who needs the care. So the spouse could still be in the home and use the reverse mortgage to pay for it because you're private pay.
Right.
And back to our point of long-term care and needing that care, of doing the reverse mortgage, and then in the years when that might happen, that you need that, you've got the money there, and then
Yes, because when those events occur, sometimes you don't have time to do what you need to do, or it might not be the best time to do a reverse mortgage or some other alternative.
Yeah.
So it's important to think about those things ahead of time and try and take advantage of any alternatives that you might have to protect yourself in the future when something unforeseen occurs.
yeah. You want to give a couple more examples of how the growth rate and how that works?
For the line of credit?
Yeah.
You know, I was thinking about that on the
Some
drive,
stories?
on the drive down here, and kind of like off the example that you did, I was thinking, I wonder if anybody has done a reverse mortgage, set up the line of credit, and just paid their closing costs so they had no loan balance at all. It'd be interesting to look at that sort of as an investment vehicle, where your investment is the amount of the closing costs, and then you have this line of credit, and it's growing over time.
Actually, I have one borrower that did. She lives in a condo in St. Paul, and not a very high valued condo. And when we did it, I think it was appraised at like $60,000 or something like that. And she did it, left the money in the line of credit. And as of a year ago, and we did this several years ago, but as of a year ago, she still had not touched the line of credit. It's there for the emergency. But the funds in the line of credit are now higher than what her home is actually worth.
Yep.
Wow.
That happened a lot in Las Vegas when the housing crisis occurred. Home values there dropped significantly. Some homes that were in the $300,000 range were down to $100,000. So my wife has clients still out there who took a line of credit, really didn't access much of it. Their line of credit is twice as big as their home is worth right now.
So, yeah.
And that, once the deal is done, it's done. The lender doesn't come back and say, I'm sorry, your house is worth less.
So in a lot of times, it seems like the reverse mortgage is not considered as that tool, that retirement planning tool,
No.
by consumers or financial advisors.
Yeah. I think that's the toughest part, is to educate some of the financial professionals, or just professionals in general. If we could get them to understand how it works, and they could give some of that information to their clients, that would be very helpful. But I know there's a big thrust in the industry talking about financial planning, contacting those people. But I think we're overlooking a large segment of the population too, because how many people don't have financial planners or any type of financial advisor? So this is kind of a two-pronged attack we need to have. But education is the most important part. I just wish everybody understood it. If they're not interested in doing it, that's fine with me.
Yeah.
But to not understand it, or to be misled and think it's a bad thing, it's just so sad, because so many people could benefit from it.
Yeah. And in conclusion, we want to encourage everybody, get the facts, look at the option of the reverse mortgage, and like you said, at least understand it, and then we can go from there.
Absolutely.
So we're going to wrap up this show. We're bringing you back for a second show. So thank you for being here and providing the information and good discussion. And again, thank you to Deb Nygaard for being my co-host again today. And information is available on the bottom of the screen. And I want to again say thank you to the sponsors, GWG Life and Reverse Mortgages SIDAC, who make the show possible. But also to encourage you to visit SavvySeniorSources.com to find resources A to V and information on the resource guide. Thanks for joining us today.
What is the secondary market for life insurance? The secondary market for life insurance is an emerging financial market that provides individuals options with their policies. These options allow policyholders to benefit from the value of their life insurance. Policies are sometimes a financial burden, especially for seniors, as premiums often increase over time. The secondary market offers financial alternatives that can help policyholders benefit from their life insurance now.
Hi, I'm Beth Paterson, a certified reverse mortgage professional with Reverse Mortgages SIDAC. Bob's wife passed away, meaning his Social Security income was cut in half. His financial advisor suggested he look into a reverse mortgage. With the reverse mortgage, he was able to take a dream vacation with his nephew, and oh, the stories that they can share. After Bob passed away, his niece shared the difference that it made to the whole family. Dorothy did the reverse mortgage in order to protect her other retirement funds. With her line of credit, she was able to travel, buy a new car, and do home repairs. Years later, she's still benefiting from the reverse mortgage line of credit and not having to rely on her children. For more information on how you too can have security, independence, dignity, and control, contact us.